It continues, my friends. Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, and it's something we've been discussing here for months. I would say 2 to 3 months, and it really got highlighted, though, with Andrew Forrest and this idea of green nickel after Indonesia at the start of the year all of a sudden seemed to be oversupplying the market with nickel, and all of a sudden we got a slew of headlines that nickel mines are shutting down. Remember that only a couple of months ago, and we saw Andrew Forrest came out and said, we need a green nickel price, really putting on the pressure on the LME. Really interesting stories on the LME coming up, by the way. So we saw it there, right? Okay, all of a sudden nobody can compete on nickel. We need some sort of green nickel. We need an environmental standard so people are rewarded for doing green nickel over non-green nickel. Now, taking a step back, what we also see is BYD threatening the entire car industry. We see Elon Musk putting out, frankly, kind of sad tweets for Elon Musk, which is, I don't know if you saw this, but it was like, hey, we have a Tesla car for under $30,000. It's something like $29,000. And underneath it said, including the savings on gas that you would have normally made on a normal car, right? So I guess you have to add the gas that you would spend on a normal car, and then that's the real price of the car. And of course, you have Janet Yellen and everybody like Ursula von der Leyen. There is a sense of, what do we do? We're in trouble here. If we don't act quickly, what are they calling it? Overcapacity. Chinese overcapacity. They're flooding the market. We've been calling it the playbook here for years, actually. This is the playbook. That being said, what's kind of brilliant about China's position is they can say, listen, we're providing green cars, we're providing solar panels, and we're doing it at a cheaper rate. We're helping the world. You have to have a global mindset here, people in the West. Where's your global mindset? We're trying to help the world. We're doing it cheaper than everybody else. And now you're all, panicking over the fact that we're providing really good cars for really cheap because you're going to lose your industries, I guess. But is that our problem? So just to set the table here. Now, we've also been noticing with this green nickel thing, as well as we've been seeing hints of it in various stories in the past, I'd say 2 to 3 months especially, is this idea that's been bubbling up that the way the West is going to compete is they're going to put environmental, ironically, perhaps, that they're going to have certain environmental requirements that are based on carbon emissions that will penalize places like Indonesia for creating non-green nickel, penalize, BYD, as we saw. BYD is building a factory right beside the nickel processing facilities in Indonesia. We saw a story on that, quite literally. So it seems like this is going to be the way that the West proceeds. Just to kind of summarize the last 2 or 3 months on this topic. Now, we have a tweet here from Javier Blas, who put out some very interesting tweets over the last week. And this one is quoting Mario Draghi, who Javier Blas says in a tweet on April 17th, is writing a report on how to revive the European economy at the request of Brussels. And of course, Mario Draghi is the former head of the ECB, the European Central Bank. So he has been asked by Brussels, basically, tell us what to do here, because we don't know what to do. This is my speculation, but basically, Mario, tell us what to do. And Javier highlighted just a specific, 4 lines that I thought were quite interesting that I wanted to share here with you. And here are the lines that Javier highlights from Mario Draghi's report. We are lacking a strategy for how to shield our traditional industries from an unlevel global playing field caused by asymmetries in regulations, subsidies, and trade policies. Energy-intensive industries are a case in point. In other regions, these industries not only face lower energy costs, but they also face a lower regulatory burden, and in some cases, they are receiving massive subsidies which directly threaten the ability of European firms to compete. They may be talking about China there, but you do wonder if they're also talking about the IRA, right? What about the U.S. and the Inflation Reduction Act? It's not clear. So one more line here. Without strategically designed and coordinated policy actions, it is logical that some of our industries will shut down capacity or relocate outside the EU. So this is pretty dramatic words, but not a surprise to anybody that's been listening to this program. As we've been pointing out the last 2 weeks, there is a sense of panic, I would argue. Maybe that's too strong of a word, maybe it's not. And then another very interesting tweet from Javier Blas on April 16th, which was actually the day before the Mario Draghi tweet. Listening to John Podesta today at the Global Energy Summit, it's clear America is expanding its on and off trade war with China into the clean energy and climate arena. Quote, "We cannot reward countries that use dirty production," end quote. So Javier Blas highlights this conference, and there was an opinion piece as well on Bloomberg titled, "The White House Has a New Trade Weapon Against China." So again, this is all just adding evidence, and the thesis is, to restate it, that the way the West is going to compete is by adding basically environmental tariffs on carbon emissions, on dirty industries, and that this is maybe the only way they can compete, other than just pure protectionism and just straight up tariffs for no reason. So here we see it in this opinion piece. Again, the White House has a new trade weapon against China. Just a couple of paragraphs here. Perhaps in time, we'll look back on this week as when a death blow was delivered in Manhattan to the World Trade Organization. On Tuesday, White House climate envoy John Podesta delivered bombshell remarks on climate policy and trade at a conference organized by Columbia University's Center on Global Energy Policy. And here's the quote from John Podesta. "Right now, our existing trade policies and the international rules that govern them don't pay enough attention to the emissions embodied in tradable goods. Instead, we need a smart 21st century approach to climate and trade policy that launches a race to the top for climate action." And Liam Denning continues in his op-ed, "That's fighting talk that comes after a lot of other fighting talk, including Treasury Secretary Janet Yellen's recent threat of more tariffs against China. Podesta has laid out the clearest declaration yet of the Biden administration's willingness to upend global trading rules, which the U.S. fostered, to achieve its twin objectives of limiting carbon emissions and Chinese dominance of key industries. As with any clash, there will be collateral damage, possibly to the energy transition itself." And here is the irony, right? And just another paragraph here. "Decarbonization today relies to an overwhelming degree on reductions in the price of clean technologies like solar panels and batteries, due to Chinese industrial policy turbocharging the country's factories. The current angst about world-beating Chinese electric vehicles owes much to the quality and cost of those vehicles." So more evidence that this is going to be the strategy. I also brought up John Podesta's remarks from the White House website, where it was posted in the briefing room in the speeches and remarks section. And here are just a couple of quotes from John Podesta. Quote, "But even as we increase investment at home and abroad, there's still an elephant in the room, one that's producing a lot of emissions, and that is global trade. We have to take a serious look at our international economic systems, including trade, and harness them for climate action. Our current global trading system was built to promote open and competitive markets, which it has done well, but it wasn't built to curb emissions. In fact, by many measures, global trade is a huge contributor to the climate problem. Emissions from shipping and aviation are a major factor. Those emissions have received a lot of attention, and they've been the subject of a lot of productive international cooperation to reduce emissions through the production of sustainable fuels and electrification where possible." And then scrolling down a few paragraphs, the United States alone imported over 1 gigaton of emissions from traded products just in the year 2019. That's the same amount of emissions we expect to reduce in 2030 thanks to the Inflation Reduction Act and bipartisan infrastructure law. This needs to change if we are to get the climate crisis under control. So you see what's being said. We can't just buy any goods and not pay attention to the emissions. Continuing with John Podesta, "Right now, our existing trade policies and the international rules that govern them don't pay enough attention to the emissions embodied in tradable goods. We don't have uniform standards or consistent, reliable data about embodied emissions." And then a couple of paragraphs down, "There is no penalty for what I like to call carbon dumping, when high emissions in production are exported back into countries with stronger climate policies. That's bad news for the climate. It's also bad news for competition, setting up a race away from robust, resilient, and diverse supply chains to those concentrated in countries with lax standards." And then finally, we get an example with aluminum. And this is going to factor in because, of course, Alcoa just had their earnings call. And the most kind of notable thing was actually their green initiatives, which I'm going to get into in a second. And with that in mind, listen to this. The U.S. used to be the world's largest producer of aluminum. But after decades of outsourcing and non-market behavior by some countries, only 4 primary aluminum smelters now remain in the U.S. Today, over half of the world's aluminum is made in China, where the average ton of aluminum produces 60% more emissions than it does in the U.S. That is a bad story for the American workers who lost their jobs and the American communities that were hollowed out. But it's also bad for the world as a whole. Globally, aluminum production is substantially dirtier than it needs to be. So we're seeing this strategy be really outlined and highlighted front and center here. And interestingly, Liam Denning is saying this new environmental angle really threatens the World Trade Organization as an institution. As Liam Denning says, perhaps in time we'll look back on this week when a death blow was delivered in Manhattan to the World Trade Organization. So, very interesting developments there as we start to see this really take shape, because there is an urgency out there. Now, continuing on, we had the Alcoa earnings call. They lost a bit of money. It was a little bit of a ho-hum call from my perspective. They had a loss of $252 million, interestingly, and they also announced an acquisition of Alcoa World Alumina. But this is what really stood out to me, which was the green strategy. And this is ChatGPT. Alcoa issued $750 million in green bonds and introduced a new green finance framework to fund sustainability projects focused on decarbonization and water management. So it's almost like Alcoa can read the writing on the wall of where this is all going and saying, hey, we need to make sure we're going full bore into the green transition here as an organization. Now, we've heard of green bonds before. The financial mechanism is aligned with international green bond principles and supports investments in projects that facilitate the transition to a lower carbon economy. The proceeds from this bond are intended to finance and refinance projects that meet specific environmental criteria, reinforcing Alcoa's commitment to sustainable business practices. Also, another initiative, Alcoa is pioneering efforts in carbon reduction technologies through its Refinery of the Future initiative. With substantial funding from Australian governments, Alcoa is piloting electric calcination technology that could significantly reduce carbon emissions from the alumina refining process. This technology, powered by renewable energy, not only reduces carbon emissions, but also enhances energy efficiency by capturing and reusing residual energy. So again, the writing is on the wall from various sources here. So very interesting there. Now, I talked about the $9,700 BYD car reported on by Electrek. There is also another headline that was a head-turner, and it's Kia's $15,000 EV2 caught in the wild as affordable EV offensive kicks off. So now there's going to be a Kia $15,000 car, and I wonder to myself, are they going to put tariffs on South Korea as well? This is a global market, and it's going to be very interesting to see how this all plays out, because they really want to put tariffs on BYD and keep them out. I mean, if you look at Electrek's headlines, it's really one headline after another of how much cheaper electric cars are going to be, literally in the last week. It's quite amazing. And finally, just in Africa, some pretty interesting headlines here. Niger to use oil advance to pay off $600 million regional market debt. So we've been talking about Niger and the coup that had happened there. Of course, it was almost a year ago. It was last summer when the coup took place. And of course, there's the well-known drone base. And just a quick update on Niger, they are taking a $400 million advance on oil production from China. And this is going to help the West African nation's junta pay debt it's accumulated since a military coup last year. So that's a Bloomberg story. Niger to use oil advance to pay off $600 million regional market debt. And this is following a story from the New York Times that is titled, U.S. Military to Withdraw Troops from Niger. The status of a $110 million airbase in the desert remains unclear as the West African country deepens its ties with Russia. So Niger warms up to Russia and China while U.S. military troops withdraw. And then finally, just an interesting headline out of the FT. India seeks to secure critical mineral resources in race for lithium. So I mentioned India the last week or two, and here's just another headline showing how India very much wants to be a major player in the critical minerals game, and it sounds like they have their own supply chain ambitions as well. Coming up this episode, I'm very pleased to welcome back to the show Cam Currie of Currie Metals and Mining Group, a part of Canaccord Genuity. And Cam comes on to discuss the gold stocks. Is it too late to invest? Of course, we've seen the huge run-up in gold in the last, I'd say, 4 months, especially since February. And so I bring the questions to Cam on what is happening and how he sees things. And again, is it too late is the big question I want him to answer, and he does. So a wonderful show ahead of you, as well as many fascinating news stories and more. If you want to find us online, you can find us at northernminer.com. You can find us on Twitter at Northern Miner, and on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, Apple Podcasts, and SoundCloud. And with that, let's turn to the news. And turning to the website, just a quick tip of the hat to Tim Gitzel, CEO of uranium miner Cameco, who is the Northern Miners Mining Person of the Year. And Alicia Hyatt has written a beautiful profile here, as well as an interview with Tim Gitzel. You can find that on the Northern Miner website. Continuing on, a sensational headline here from Bloomberg News via mining.com. Glencore and Trafigura's sanction games are draining the LME. As if we didn't have enough to worry about. Now, according to Bloomberg, in this very sensational headline, the LME is being drained. Let's see what it says. The world's two biggest metal traders are moving to withdraw large volumes of aluminum from the London Metal Exchange in a complex trade made possible by new UK sanctions on Russian metal, raising questions about unintended consequences from the new rules. Trafigura Group and Glencore plan to withdraw the metal to profit from a new multi-tiered system created by the sanctions, according to people familiar with the matter. The trade involves ordering out Russian metal and then re-registering it on the LME under a new, less desirable category, while striking profit-sharing deals with warehouses to receive a sliver of the rent paid by the future owners for as long as it sits there. So, quite a esoteric move here on the part of Trafigura and Glencore. But the result is not so esoteric. Nearly $400 million of aluminum was requested for withdrawal this week from warehouses in South Korea and Malaysia, according to LME data, driving live inventories in the warehouse system close to a record low. Trafigura and Glencore have both been behind orders for withdrawal of aluminum this week, according to people familiar with the matter. The play, which has captured the attention of the global metals world, raises questions about whether the UK government was aware of the opportunities it was creating for traders to game a complex set of rules imposed by the sanctions last week. The nature of the trade means that the metal will ultimately be placed back on the LME, but the restrictions have added new layers of paperwork and approvals as traders must prove the provenance of the metal they are registering, which is likely to slow down the process and keep LME inventories lower for longer. So, very interesting development there. Continuing on, Biden calls for tripling of tariffs on Chinese steel. This is Reuters via mining.com. U.S. President Joe Biden is calling on Wednesday for sharply higher tariffs on Chinese metal products as part of a package of policies aimed at pleasing steelworkers in the swing state of Pennsylvania at the risk of angering Beijing. As he makes campaign stop in the steel city of Pittsburgh, Biden will propose raising to 25% the tariffs imposed by his predecessor, Donald Trump, on certain Chinese steel and aluminum products, according to an administration official. Scrolling down a bit, the Biden administration is also pressuring neighboring Mexico to prohibit China from selling its metal products to the United States indirectly from there. At the same time, it is launching an investigation into Chinese trade practices across the shipbuilding, maritime, and logistics sectors, which could lead to more tariffs. The measures, which are being unveiled as Biden visits the headquarters of the United Steelworkers Union, invite blowback from China at a time of already heightened tensions between the world's two biggest economies. And further on the steel front, Biden and steelmakers promise U.S. steel will stay American. This is Reuters via mining.com. U.S. steel and Japanese buyer Nippon Steel said the Pittsburgh-based firm will remain an iconic American company even after a planned $14.9 billion takeover, echoing President Joe Biden's promise to local steelworkers. The two steel giants responded hours after Biden on Wednesday pledged that U.S. Steel would remain, quote, a totally American company, repeating his opposition to the deal. Quote, "And that's going to happen, I promise you," end quote, Biden told the supportive crowd during an event in Pittsburgh. And the steelmakers, U.S. Steel and Nippon Steel, put out a joint statement, and it said, quote, "The partnership between U.S. Steel and Nippon Steel is the right combination to ensure the U.S. Steel remains an iconic American company for generations to come. Its iconic name will be unchanged, and its products will remain mined, melted, and made in America," end quote. Now, copper has been making some big moves here. The last I checked, it was at $4.49. We will check again in the metal prices section. Here's the headline. Copper market grapples with a crucial question. This is Bloomberg News via mining.com. Over the past few days, the world's copper traders and executives descended on Santiago for the annual Chesco Week gathering. The main debate, is this the beginning of the big bull market everyone has been waiting for? Prices touched a 22-month high of $9,739 a metric ton on Thursday, up 13% since the start of the year. Nick Snowden, the Goldman Sachs Group strategist who has carved out a place for himself as the market's most bullish voice, argued copper's latest developments are only, quote, "the foothills of what will be its Everest," end quote. He forecasts prices will average an astonishing $15,000 per ton next year. I mean, don't forget what Jeff Currie was saying, former head of commodities at Goldman Sachs. Don't forget what he was saying, where copper's going to pull in oil, referring to when oil went from $10 a barrel to $150 a barrel. Going back to Nick Snowden here, the bullish strategist at Goldman Sachs, just to read the line again, he forecasts prices will average an astonishing $15,000 per ton next year. That's just the average price. That doesn't include any peaks, right? Now, the article continues, not everyone agrees. On a fundamental basis, the indicators suggest that the price has gone too far. Alice Fox, commodity strategist at Macquarie Group, said in Santiago, she is no copper bear, but she thinks the current rally is a little premature, driven by bullish investors rather than any shortage of the metal. This is the kind of thing, this next headline is the kind of thing that is often forgotten, is like, this is a real world industry. And let me read the headline here. Zambia copper mines hit by state utilities warning of power cuts. I mean, if you're doing analysis on copper, are you going to be thinking of potential power cuts in Zambia? This is Bloomberg News via mining.com. Zambia's state power utility has served notices of force majeure on supply of electricity to some mines, according to an industry association, threatening additional pressure on a copper market going through an unprecedented squeeze. The Chamber of Mines in Africa's second largest copper producer said Wednesday that power utility Zesco has notified several of the organization's members that it can't fully meet its supply commitments. The statement didn't say which projects are impacted. And just finally here, the market for semi-processed copper ore, known as concentrates, has never been as tight as now, Bloomberg reported last week, citing veteran traders. That is quite a statement. The market for concentrates has never been as tight. According to veteran traders, the pressure has been building for several months, driven by the surprise closure of First Quantum Minerals' Cobre Panama mine, followed by downgrades to production guidance from Anglo American. Codelco, the world's top producer, has also seen production slump to quarter-century lows. And also, another metal that's rallying is tin. And here's a headline from Reuters via mining.com. Tin price rallies, inventories fall after one party takes big position. And just a couple of paragraphs here, tin prices and spreads extend their sharp gains on the London Metal Exchange on Thursday in the wake of a large position taken by one party, fund buying, and worries about supply. The LME benchmark tin price is by far the top gainer on the exchange this year, surging by 31% compared to 13% for copper, as speculators have piled into the market. LME tin advanced 4.2% to $34,160 a metric ton on Thursday, its highest since June 2022. And then we have a quote from a trader, who declined to be identified, quote, "This is speculation on the back of fundamentals. I would rule out a consumer or a physical player," end quote. And finally, supply of the metal mainly used for solder and electronics has been hit by disruptions in Indonesia, Myanmar, and the Democratic Republic of Congo. And we have another quote from analyst Yuting Du at broker Marex, quote, "There is still a lot of uncertainty about when Myanmar will resume its production, whilst the semiconductor industry is still driving strong downstream consumption," end quote. Macquarie expects a global tin deficit of 8,000 tons this year and a shortfall of 12,000 tons in 2025, compared to a surplus of 8,000 tons last year, analyst Sukriti Kalra said in a note. And more inventory is being taken off the LME. Worries about supply of drawn material out of LME-approved warehouses, sending inventories sliding by 45% so far this year to 4,245 tons. So more metal being taken off of the LME. And just another headline here, this time it's Bloomberg via mining.com. Short squeeze fears grip tin as LME says it's watching the market. And there is a mystery buyer here. Scrolling down a few paragraphs, but market chatter in recent weeks has focused on the role of a single bullish trader that's tightening its grip on LME tin. That entity is holding at least 40% of long positions on tin for May delivery, according to regular exchange data that doesn't identify holders. That level of concentration hasn't been seen since 2017 and equates to at least 90% of the volume now held in LME warehouses. Holders of short positions could find themselves in a tight spot as the May contract approaches expiry. And finally, Indonesia's March refined tin exports down 19%, Trade Ministry says. This is Reuters via mining.com. Just a line here, Indonesia's refined tin exports in March were down 19%. Year on year at 3,858 metric tons, data from Trade Ministry showed on Friday. Exports of mining products from Indonesia have been affected by delays in approvals of annual work plans for mining companies after changes to the approval process at the mining ministry. And finally, just a couple of headlines. Canada's planned capital gains tax hike may choke mining startups, steelmakers say. This is Reuters via mining.com, and they're quoting Ron Birnbaum, who we had on the show, as well as John McKenzie, CEO of TMX, and they were talking about flow-through shares. And here's a quote from John McKenzie, CEO of TMX Group, parent of the Toronto Stock Exchange, quote, "The increase in the inclusion rate on capital gains has been characterized as a tax on the rich, but it is in fact a tax hike on investing in Canada that will serve as yet another barrier to economic growth." And here is Ron Birnbaum, CEO of Pear Tree Canada, quote, "Exploring for resources is venture capital at its riskiest," end quote, noting that flow-through shares offer a, quote, "successful incentive," end quote. And the article continues, industry lobby groups are hoping that the government will offer an exemption for flow-through share investors. And here's Birnbaum again, quote, "If not, it means the likely end of more than 70% of all resource exploration in Canada." End quote. So no shortage of dramatic news here. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market. For context, the U.S. 10-year bond is yielding 4.62%. That is 0.01% lower than last week. And the UK 10-year gilt is yielding 4.22%. That is 0.03% lower than last week. And the Italy 10-year bond is yielding 3.82%. That is also 0.03% lower than last week. So yields edging lower, turning to precious metals. Gold is trading at $2,323.50 per ounce. That is $63 lower than last week. Silver is trading at $26.96 per ounce. That is $1.54 lower than last week. Platinum is trading at $932.10 per ounce. That is also lower. That is $47 lower than last week. And palladium is trading at $1,018.50 per ounce. That is $18 lower than last week. Turning to industrial metals, copper is at $4.49 per pound. That is 13 cents higher than last week. Iron ore is unchanged at $104.33 per metric ton. Aluminum is higher at $1.21 per pound. That is 5 cents higher than last week. Lead is at 98 cents per pound. That is a penny lower than last week. Nickel is at $8.93 per pound. That is 75 cents higher than last week and almost at the $9 mark for nickel. So big jump there. Tin is at $16.14 per pound. That is $1.46 higher than last week, so big jump in tin. Cobalt is unchanged at $12.62 per pound. Lithium is slightly lower at $15.26 per kilogram. That is 27 cents lower than last week. Uranium is trading at $89.30 per pound. That is 55 cents higher than last week. And zinc is at $1.28 per pound. That is 2 cents higher than last week, continuing its climb, showing a lot of strength there. Zinc as well as tin and copper. So a tale of individual markets here, with precious metals taking a breather, edging lower, with aluminum, tin, and copper, as well as zinc, looking strong. So it is all about supply issues in individual metals this week, and those are your metal prices. Coming up, I'm very pleased to welcome back to the show Cam Currie of Currie Metals and Mining Group, a part of Canaccord Genuity, and we have a wonderful discussion on macro, gold stocks, silver, other metals, copper, and is it too late to invest in gold? And much more. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the program Cam Currie of Currie Metals and Mining Group, which is operating in the Canaccord Genuity mining brand. Cam, welcome to the show.
Adrian, thanks for having me back.
It's wonderful to have you back. It seemed like it would never happen, Cam. The gold price has finally started to make some moves here in the last, is it November, December, since we were down in I think we had an 18 handle on gold at one point a few months ago. And here we are. We have a bit of a pullback today, but we're kind of sitting on top of $2,400. And so there's a lot to talk about here. So I'm really pleased to have you on. Before we get into it, tell us, what exactly is it that you're doing at Currie Metals and Mining Group?
We're specialists in the sector. And I think in today's investment world, most investors dealing with wealth management basically get invested into plug and play ETFs. And so we strongly advise people to have 5-10% of their portfolio in metals and mining stocks and assets. And there's nobody really a specialist in that space anymore. And so we've recognized this great opportunity, especially given the fact the sector, in our view, is very undervalued and very under-recognized. So we're reaching out to family offices of high net worth and explain to them why they need a percentage of their portfolio in this sector.
And I imagine they are quite a bit more sympathetic these days as we're seeing a changing narrative. And of course, you are an adherent of Robert Shiller's narrative economics. So my question for you here to get us started is, what has changed in the narrative for gold and silver in the last few months since we last talked?
Well, for people inside the sectors, a lot has changed. But people outside the sectors, especially in North America, to a large extent, they're not really paying attention. You know, we've had these significant rallies, obviously, in the Mag 7 and the AI stocks and the cybersecurity stocks. Indexes going to new highs here recently. And yet that is getting the narrative. And yet fundamental underlying markets are very different. For example, 2023, if you took out the Mag 7 earnings, the S&P lost, or earnings were down 1.9%. Most people don't know that, right? So the narrative towards the indexes and the story stocks of today, and again, I'm not saying AI is not an incredible industry going forward here, but that still is getting all the attention. So as gold's moved itself up to 2,400 here as of last Friday, people are starting to think about it, hear about it, but there's no money flows. You know, I deal with a number of funds, and the funds have zero money flows coming into the space still. If you go over to Europe, people are talking about it more so there because they're not beside, the United States equity market arena like we are here in Canada. On the physical side, that's really a driving story that people don't understand. I mean, if you look at ETFs in the United States, they've gone from 3,600 tons down to 2,500 tons here in the last 17 months. And yet gold's trading at all-time highs. A lot of that has to do with big demand out of Asia, Middle East, and the BRICS nations, central banks. But most people don't know this, but in China, for example, last year, the second best performing investment for Chinese investors was gold, up 12%. Chinese investors are hard asset buyers, and the real estate market's been upside down for quite some time. So they're big buyers of gold. And the Western world's just not paying attention to that. And so going back to the narrative, there's a breeze starting, but no one's really went, okay, this is a shift. And we have to take a serious look at this sector. And we haven't seen that yet.
It's so interesting you bring up China, and a lot has been said about China as far as its relationship to the gold market, what's going on. Some people will say maybe they're buying metal over treasury bonds, but it was quite interesting. I was looking at Jeffrey Christian's gold report that he puts out annually, and he released, I think, a couple of weeks ago. And it told another story to a certain degree when I was looking at the holdings of central banks from around the world. And what I saw was there was the US, and then you saw a second kind of tier of countries. And then at the very bottom was China. They were just entering this second tier of gold reserve holders. And to me, that told so much of the story. Like, obviously, if you're China, you want to at least be in the second tier and ideally on the first tier. Do you have any thoughts on that?
Well, you have to look at the G7. You look at Germany and you got Switzerland, you got the United States, the big holdings of gold. They've been sticky with their positions for a long time. Now you have a whole new buyer in the gold market, these other central banks. And I have to, call out the World Gold Council for doing a great effort on this, because they hold symposiums for central bankers around the world, educating them about gold as an asset class in the reserve base. And a lot of these meetings now are standing room only, because you have a world that was so overweighted in US dollars. And what you're seeing now, but no one's really talking about, is that people are getting more and more concerned about US dollar holdings. And that's why we're seeing a movement out of US dollar treasuries into gold. And yet that's not a mainstream media event taking place in the United States for obvious reasons, because they're the reserve currency of the world and they don't want to recognize the fact that you're seeing a diversification out of US dollars. And so that shift and that accumulation isn't a short-term trend. It's been happening since the financial crisis happened in 2009. And so since then, the foreigners have looked at their US dollar holdings and they've been concerned that they're just too exposed. And, when you have people like Jerome Powell saying that we're on an unsustainable path, last year they had a $2 trillion deficit, yet unemployment was at 3.8%, record low, and you still ran a $2 trillion deficit, there should be concern. But bringing this up to American investors, no one really wants to talk about that, because they're just busy, in their performance stocks and their momentum stocks, and that's where they want to play. So there's a shift, but the shift isn't just short term. This is like a freighter that's changed direction amongst these central bankers, and they're looking at gold as a reserve currency. And just to touch on that just briefly, if you look at the foundation of fiat currencies in the first place, they were IOUs off of gold. So when you think about that, you have trillions of dollars of fiat currencies and $300 trillion of global debt now off of fiat currencies. And it was all based on a foundation of gold. So what you're seeing right now amongst these autocracies and these other central bankers is they're saying, here's back the fiat currencies, the US dollar, which is impaired with the debt and the printing presses. We want the tangible gold back. And if you really think about that, that's what's taking place.
In a sense, it's taking us back to this pre-closing of the gold window world where people want their gold again. It's quite interesting. I mean, you talk to a lot of people in the industry. What are they saying? Are you hearing anything interesting from the many interesting people you talk to in the industry?
Well, first of all, I speak to all gamuts in the industry. I was talking to World Gold Council on Friday, and they were talking about the insatiable demand for gold out of Asia. But they're also pointing out the physical demand in the United States, despite the ETF sales, has been picking up. And that's a positioning of investors, smart investors, who are looking at the U.S. economy, and they're concerned about valuations of equities. They're concerned about the fiscal house, the deficits, and they're starting to realize that the delayed reaction on this recession is disappearing, and that the slowdown is taking place. And so they're positioning for the rate cuts. Now, the narrative right now towards gold is when the Fed cuts, gold goes higher. When the US dollar weakens, gold goes higher. And that's the setup. So you have some positioning there. But if you talk to gold funds, I was just talking to two of the very big primary figures last week, and the gold funds have no money flows coming in yet. There's zero money flows. I said to them, unfortunately, one of them, I said, you're going to be a secondary flow of money, because the first money flows are going to be passive ETFs, because nowadays the average investor buys ETFs. And so the passive flows will drive first. And when we get the price action, then people will be looking for managed money. And that's when the money flows will come into the gold funds.
It brings up a really interesting point, because I think you've kind of illustrated well the mindset of the average investor these days, they say, okay, if I want to buy gold, I either buy GLD, the ETF representing gold, or I get GDX or GDXJ. So for listeners here, you're an expert in these things. How are you playing this market, and how should they play this market? We have a pullback, down to 2,300. Is this a buy the dip market? Like, how should people play this?
Well, first of all, I don't buy ETFs because ETFs spray into an umbrella of companies that are in that criteria. And some companies undeservingly get put into indexes because of market caps. And then once they're in that index, then when there's money sprays into that index, it gets sprayed into those companies. And so buying specific companies, we put together portfolios for clients depending on their risk profile. We've outperformed the ETFs because the ETFs are spraying into the basket. I mean, most people don't know this, but the only S&P 500 listed gold company is Newmont. And Newmont hit a low of $30 here at US about 3 months ago, far underperforming a number of the other seniors. Now it's bounced to 40 post the Newcrest acquisition. But, most people that are looking at the gold sector are looking at these big caps, and they've been underperformers, whereas the mid-tiers and some of the developers, we've had some great performance. So the ETFs don't really paint the picture. So strategy-wise, we look for mispriced assets with great management teams and great assets. And, quite honestly, a lot of times we're buying them and they're 30% cheaper in this market where there's been no money flows. And now they're starting to get re-rates. So how am I playing it right now? I mean, gold's down $60 because there seems to be some quieting down of the situation between Iran and Israel. But the problem's not going away. And so that's only one component. We have, obviously, the Ukraine war. We have this going on. We've got a lot of geopolitical risk going on. We've got 40 elections happening around the world right now, one of which is the United States, which is going to be very interesting moving forward. But I think the big thing that's going to start getting the narrative is when the unemployment rate goes up through 4% and we do start seeing the slowdown. Interesting, last week there was an interview with one of these regional bank managers. They have 350 branches in the southern states. And he made the comment that they're starting to see the consumer tapping out. And I think it's surprising to most economists last year who were calling for a recession that the consumer stayed strong. But I think they stayed strong because 30-year mortgages at 2.5% kept them alive. And people weren't moving. So if they weren't moving, their savings function was going into consumption. And I think now that consumer is starting to tighten up.
Well, it's quite interesting. And I wonder to myself as well, like even a rising stock market, it's almost like we got this echo boom from 2021. So maybe part of the reason the consumer is doing well is because their stock portfolio is not doing terrible right now.
Absolutely. Absolutely.
Okay, so very interesting. Now, I assume part of Currie Metals and Mining, you just mentioned the mid-tiers, investing in companies that go beyond the ETF. What is your sense then of the exploration sector right now? I mean, there's a bit of a debate, I would say, at least on this show, between the great majority of exploration company CEOs and executives and analysts who are saying, the sector is starved for capital. And I had Rick Rule on about 3 weeks ago, and he said, no, they're overfunded. I suspect he's being provocative, but I think his point was the terms weren't good enough, I think is where he's coming from on this, looking to invest, really. What are your thoughts on the exploration sector right now, gold and silver in particular?
Well, first of all, they're not overfunded. Some of the good companies are overfunded, but there's a lot of companies out here. Some of them unduly are underfunded. Some of them should not be funded. There are a lot of companies out here that are living on ether right now that perhaps, aren't going to survive this. But again, there's no money flows coming into the space right now. And so, talking to one of the fund managers, if he's going to buy something, he has to sell something. So when it comes to risk profile, buying the junior exploration companies right now, they're probably great buys if you have that, 2-3 year horizon and believe in this trend that we believe is taking place. But right now, there's just no money. And so there's a number of great exploration companies out here that have come down, 80-90% from their highs. And, you talk to these management teams and it's almost quasi-depressing because, gold's at 2,400 and their stocks are in disrepair and they have no money to execute on their exploration programs. Who would have thought 2 years ago at $2,400 gold, we'd be sitting in this situation, right?
Indeed. And it does make me wonder, say, because put it this way, pragmatically, if I'm going out there, I understand the reasoning, say, that you say that, okay, some companies are unduly valued to a certain degree, and they're included in these ETFs just because they have large market caps, and this it becomes a self-fulfilling prophecy. But as an investor, I just go, well, maybe they are junky companies, but it does tend to reflect, I think GDXJ is up, 30%, which is okay. I mean, it's a little better than the gold price. And GDX, I think, is up something like 20%, which is probably on par or close to par with the move in gold. So there is a sense that just on a purely pragmatic perspective, I guess a reverse way of asking this question is, can this be a value trap where you go, hey, there's all these beautiful mid tiers? I guess it's all about choosing the right one. But do you see what I'm saying?
Mm-hmm. I do. And you have to put in context too. The sector is a very, very, very small sector. With this price move a little bit different, but the market cap of the entire global precious metal sector was less than Home Depot a few months ago. So it's important for the listener to understand how tiny it is. And so when you actually take it from that perspective, then you look at the seniors and the mid tiers, how few companies there are. And so, you're looking at the mid tiers. The mid tiers are fairly priced right now because there's money flows that have come into them. And yet there's a value gap to the next level down. You look at some of these developers that are de-risking their projects and advancing them, they're trading at 0.2, 0.3 times NAV. And because there's no money flows coming in and they aren't at a market cap and liquidity event where they get indexed and re-rated, if that makes sense. So there's an opportunity to sift through and find those companies. And it's been tough because last year we saw a lot of cost inflation in the sector, so the margins stayed the same. I think this last quarter we just finished, March 31st, when the numbers start coming out in May, it'll show a percentage increase in margin expansion for the first time. I think that'll be something that people will start recognizing. And given the fact that gold's at $2,300, $2,400, last quarter it was $2,050 on average, maybe $2,000, $2,100 on average, that now the gold price is $200, $250 higher, then the market will be thinking, okay, well, if that expansion took place given that quarter, the next quarter should be a greater expansion, right? So that percentage increase in profitability should start garnishing more attention amongst the generalist funds.
And indeed, we are in earnings season right now. Is there anything you're looking for? I mean, you mentioned Barrick and Newmont. They are underperforming. I guess they're performing alongside the ETFs, I suppose, up 20 or 30%. But still, I mean, considering where Newmont was, I think it was at $70 or $80, not that long ago. What are you looking for in earnings season? Is there anything you're listening for?
Well, margin expansions, getting costs under control. That's what I think everyone's looking for. The problem is, Newmont bought Newcrest, okay, so that expanded their growth platform. But you look at Barrick, they just came out last week and, declining revenues, declining production, and increasing costs. And this is a really, really important factor that people have to understand, is that because so much money flows went into other sectors, that our sector had no capital into it. And so you look at since 2010, 2012 to current, you look at the resource funds in North America, they were like 12 billion, now they're 2 billion. In Europe, there were 40, now they're 12 billion. Because money left the sector and it went after all the other sectors. And so there's been an absence of money going into exploration and into capital expansion. And so that will bode very well on price action moving forward because you can't fix the supply problem going forward. We're seeing that in copper, for example, right now. China just shut down a couple of their smelters and all of a sudden copper's taken off. It wasn't necessarily a demand side, it was a supply side thing that drove copper prices higher.
It is fascinating, and that's exactly where I want to go next, is what other metals are you looking at? And I was going to mention copper. I mean, copper, we're right around $4.50 per pound. So what do you think about this? And we've talked about copper here before. Are there any other metals you're looking at? Is this kind of a broad rally across the metals? How are you seeing this, even within the sanctions that we just saw? How are you looking at other metals right now?
Well, primarily I'm copper, gold and silver. Lithium, we made a lot of money in the lithium space. I'm still sitting back, waiting there because the narrative off of EV, and you're seeing it already with the automakers in the States now going to hybrid and cutting back on their EV expansions and that. So the narrative is put that into the penalty box. And so, but it's just something to monitor. But on the copper side, there's just a scarcity of assets. And that's the thing. And, I'm still one in the recession camp here, where you got England in recession, you got Germany in recession, Japan's in and out, China is debatably in a recession, Canada, I think we're just going to recession. So I think that could limit the price action on copper at this point. But long term, there's just no new projects coming down the pipeline. And you start looking at the geopolitical risks around the world right now, and U.S. won't build a copper mine in Arizona because of the green movement. And so supply is a huge problem. But the capital to be spent on these projects, I mean, we were very fortunate to get involved with Filo, the Vicuña district, and that's going to be, that's the most prolific copper district evolving in the planet right now. But you're 79 years until that comes into production. So it doesn't matter what price action does for copper right now, supply can't be changed quickly. And that's a big problem.
Okay, interesting. So you are mostly focused then, say, on, as we were mentioning, precious metals, gold, silver, copper, and waiting for lithium to turn. Maybe it's too early. And so that's the main focus. Is that fair?
That's correct, yes.
Okay, excellent. So just as we're starting to wrap up here, then, I kind of had a fun question here for you. I mean, a lot of people, we have Sergei Lavrov saying we're very close to the closest we've come to nuclear war in a long time. What's your plan B as far as, do you have a plan B if things really get kind of crazy out there? We always kind of constantly have this chatter of things could go off the rails for decades. I mean, it's always there. But now it seems like it's just a little bit closer. What's your plan B? Do you have a plan B?
Well, part of my strategy is on precious metals as part of your portfolio is the escalating geopolitical risk. We've been talking about this for a number of years, and the economic risk. As we talked about before this interview, Adrian, that global debt went from $200 to $300 trillion when interest rates were zero. Now we have interest rates multiples higher than zero, of course, and the debt is becoming a burden. So, I've been looking at a situation here where I think, we have headwinds, and now you have the geopolitical headwinds escalating themselves. And, one of the things I've talked about in numerous interviews is the autocracies versus democracies. And the autocracies, if you look at it, they're the ones that are realigning their central bank reserve bases out of US dollars into gold. And I think what you're going to continue to see here is the autocracies trying to show the weaknesses of capitalism and democracy. That's what's on the table right now. And I think you're seeing more and more of that. And so my biggest concern, quite honestly, is financial risk moving forward. I mean, we hear it time and time again from people like Jerome Powell, who are on an unsustainable path. Well, we are on an unsustainable path. I mean, global debt and deficits continue. Fixed costs of governments don't disappear. And so you look at Medicaid, you look at Social Security, you look at the risk moving forward here. If we do slip into a recession, the Fed balance sheet's still at $7 trillion. US debt's at $34 trillion. And so how do you fix that problem? Then you strap on the geopolitical risks in the Middle East and Ukraine and the risk of China, Taiwan. There's a lot of turbulence out here. So my plan B is my strategy of plan A, which is, having precious and base metals, primarily precious metals, as a hedge against geopolitical and financial risks. That I'm shocked we haven't seen greater cracks in the system here. But when you have that much liquidity put into the system, it takes a while for it to come out. And you also have, human behavior. People are creatures of habit, and they haven't had adversity for a long period of time. So people aren't really worrying about it still, which is surprising.
So just as we're wrapping up here, then, is it too late then? Do you have a message for investors here that are listening? Some might feel like they missed the move. It's always kind of quick when gold starts moving, and before you know it, off and away, it's at $2,400. Is it too late?
Absolutely not, because the price action in gold has not met with the price action in the equities yet. And I use the word price action because, it's very important. If you look at bull markets, whether it's crypto, digital, cannabis, price action creates a narrative. And once there's narrative, then there's money flows. Well, we've had some price action and we're getting a little bit of narrative. Citi just came out with a $3,000 upgrade target price on gold. Goldman just went to $2,700. But you're not hearing narrative to a great extent on that. Everyone's wondering about the dip on the NVIDIAs and the Teslas and the Apples and that. And no one's really looking in the other corner about gold trading at all-time highs. And so narrative is going to eventually get to a critical mass where there's money flows. So absolutely not. And what's really going to be interesting to watch right now. We have gold pulling back because of more neutral feelings in the Middle East right now. But watch the gold stocks, because as the gold price comes off, you're going to watch the gold equities under accumulation, because smart money is going to start buying into the leveraged side of gold as they see fit here. And I think what's going to happen here is that as the economic data starts showing the weakness we're anticipating, then people will get more and more concerned, and that'll be the rationalization for the narrative to really pick up on gold and gold equities. So listen for that. That's really important.
Finally, how can people find out more about Currie Metals and Mining Group?
Well, the best way, just go on the internet, do some research and dig into, our platform, our history, and our endorsement from the industry. And if you're interested, reach out. One of the problems in today's world is there's very few people who are specialists in this space. In Canada, we used to have a lot of investment advisors, a lot of investors focus on the resource space. And, we're a very rare breed. And that's one reason why I'm so motivated in the space right now, because no one's really paying attention. You kind of look over your shoulder going, okay, how can this be taking place? And no one's really paying attention. It's because everyone's chasing all these narratives in the financial media, which are, in my view, are grossly overpriced.
Well, it recalls that great James Dines line, you have to look wrong to be right. Thank you again, Cam Currie of Currie Metals and Mining Group, operating in the Canaccord Genuity Money brand. Thank you for joining us and sharing your insights on this week's Northern Miner podcast.
Thank you once again, Adrian.
Thank you once again to Cam Currie for appearing on this week's podcast. And thank you, dear listener, for your ongoing support. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.